Welcome to the Whitwam Wealth Real Estate Podcast. On today's episode, are home interest rates dropping in 2026? What real estate investors need to know.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and on today's podcast, our topic is, are home interest rates dropping in 2026? What real estate investors need to know. Some of the questions that are bouncing around right now are, what is going on with mortgage interest rates, and are they going to go down in 2026? You know, it's really interesting because over the last 3 years, I've been in many meetings, some with real estate investors, some with mortgage lenders, some with private lenders, and all of them have talked about how interest rates are going to come back down, Oh, in 6 months, interest rates are going to come back down. And for 3 solid years, we had not seen interest rates come down. In fact, it's for the first about year and a half, we saw them just skyrocket and then hold. So this is a really interesting topic as we go into 2026 and talk about interest rates. And if they do, what is that going to mean for us as investors? It's going to mean something different for us maybe than it will for a homeowner. Since interest rates drive our real estate economy, they drive our cash flow, they drive affordability, property values, rental demand, exit strategies, all of those things. This is kind of an important topic. Interest rates even drive investor psychology and sentiment. When the interest rates are going or trending or moving, it creates something as far as how we're going to move, whether we feel comfortable with moving, what we think about the economy. But I want to break some of this down. And today we'll cover, first off, where interest rates are coming from. Number 2, what is controlling the mortgage interest rates. Number 3, what is the being signaled for 2026. 4th, why rates may not drop as fast as investors hoped. 5th, what lower rates mean for real estate investors. And 6, smart plays investors are making in 2026. So let's get into it. Number 1, where interest rates are coming from. Okay, so how did we get here? To understand where rates are, and where they may go in 2026, we need to understand how we got here. So from 2020 to late September of 2021, there were historically low levels of interest, some of the lowest interest rates in modern history. According to Property Calc, rates were under 3% through September of 2021. These historically low rates, they fueled huge buyer demand. And they caused escalating home prices and also caused record refinancing activity. Because if you're in a house you didn't want to sell and you could get super low interest rates, you were certainly taking advantage of that. Then beginning in late September, interest rates began to climb. The Federal Reserve started moving the target rate up and home interest rates began following. Inflation began to spike due to government overspending coming out of COVID. In response to inflation, the Federal Reserve aggressively raised interest rates. First they told us that the inflation was just transitory. Don't worry about it. It's all going to be good. We encouraged the government to continue pumping money into the economy. And by the time that they realized what had happened, their only response was to go on a rapid rate increase. And by May of 2022, the real estate market was cooling off. By 2023 and through 2024, mortgage rates hit new levels, into the 6s and sometimes all the way up to the 8% ranges, depending on where you were and what month it was. With the interest rate reset, it caused a severe slowing in our real estate industry. And if you've been a real estate investor for very long, you don't need me to tell you that, but it certainly caused a cooling off. Then something strange happened. Buyers began to pull back, and in some markets, we saw real estate sales drop by 60%. But also sellers disappeared. causing some markets to see very low listing levels and very low inventory, keeping prices rising. So generally when buyers pull back, prices come down because there's not as near as many buyers in the market. We don't generally have sellers pull back at the same time buyers pull back, but that's exactly what happened in this economy. And for us investors, we had to recalculate the deals to make sure the numbers all work. Many investors were losing money hand over fist, and we were seeing investor foreclosures in private money markets and in the hard money markets. We saw these begin to increase. We entered into an affordability crisis as cumulative inflation would hit a 30%, which is just unheard of. And this has become one of the biggest challenges we've seen in decades. Then comes Q4 of 2024, and optimism starts to enter the marketplace. Well, what happened in Q4 of 2024? We had a presidential election and a new president was elected. But of course, even though the election's in November, he doesn't take office until around the 20th of January. So then in 2025, it ushered in a new economic plan with a new administration and a new president. And it started a policy war with the still acting Fed chair, Jerome Powell, and President Donald Trump, with two different visions for the economy and monetary policy. And now, as we've crested into 2026, investors are asking, is mortgage rate relief finally coming to the marketplace? All right, so here's point number 2. What is controlling mortgage interest rates? Well, let's be clear, because there's some common misconceptions. Even though we talk a lot about the Federal Reserve does not directly set mortgage interest rates. Instead, mortgage rates are influenced by inflation trends, the Fed's benchmark interest rate, the overall economic confidence, which drives these things called mortgage-backed securities in that bond market. And when inflation levels cool and economic growth slows, rates tend to come down. When inflation rises or the economy gets super hot, rates tend to move up. So the rate dropping question is a matter of several factors. The first is, will inflation remain comparatively low like it is now? We've seen inflation pull back in this last year since the change in administrations, and we're seeing a much lower inflationary rate. Will the current Fed be comfortable easing their monetary policy and start to lower interest rates even more? Will bond sales drive lower mortgage rates? We'll get a new Fed chairman who has a different monetary policy, more in line with the White House's economic plan very shortly. Fact is, in May is when the current Fed's term ends. And so we're going to see some changes in the economic, policy with regards to the Fed and the target interest rates. So here's point number 3. What is being signaled for 2026? So looking at economic projections and, market expectations, most analysts believe, and I can't say all because I think right now it's more than a most. I still hear some naysayers out there. I think that interest rates in 2026 will likely be lower than the last couple of years, but not as low as we saw in 2020 and 2021. Okay, that's actually a pretty easy prediction to make, and I think it's a pretty safe one. As of now, the signal suggests gradual easing and not a dramatic drop in rates, at least through May of this year. I think we're going to see a very tempered Federal Reserve, and I think you're going to see interest rates, probably come into, maybe mid-5s type thing, but I don't think we're going to see a dramatic decrease. But then all bets will be off with the appointment of a new Fed chair. Most experts anticipate a realistic range somewhere around the mid-5s, But I think with the new Fed chair that we may hit, the upper fours. To some people, this may not sound real cheap. Okay, so if you only experienced interest rates from 2018 to first part of 2022, and you believe good interest rates are 2.5%, 2.75%, 3%, 5% may not sound cheap. But compared to the past, compared to history, it is still historically low. Even so, we should begin to see improvements in affordability over time, which means increased buyer confidence. It will unlock some of the pent-up buyer demand, and it'll increase investor sales, which will also, I think, benefit rental demand. And we should also see some hard money terms, some private money terms getting better for the investors. So here's number 4. Why rates may not drop as fast as investors hoped. There is a chance that rates may stay stagnant for the next couple of months. And kind of here's the reality check. The economy is getting better, though it's not being realized yet. I guess the best way to explain this is the difference between trying to change directions in an F-18 and in a 747. When the United States makes economic changes, we begin a turn in a very big financial machine like a 747. And it takes miles and miles and miles to turn that 747. Where an F-18 pilot, which would be like a small country or a city or a town, they can actually change on a dime. They can make the decision to change. The F-18 can change direction quickly because the economy is smaller, the impact is smaller. But I don't think that people are starting to feel and realize what is actually happening. Inflation has come down. The core price index has come down. Economic growth, durable goods are all up, and real wages are up. The first time in 4 years, people's wages are starting to outpace inflation. And so even though inflation hasn't hit this imaginary Fed target rate, it is still within the normal ranges going all the way back to World War II, almost 100 years. So even though people aren't feeling it and realizing it yet, they're going to begin to, because the big new beautiful bill that was passed, there's some huge tax advantage for tip earners, for wage earners, for Social Security earners, for overtime workers. There's going to be less money being taken out of your paycheck every month, withheld. Refunds this year will be much bigger than they have been in the last few years because taxes are lower, and that's going to build some relief. Also, with interest rates coming down, it's going to help with the affordability issue. Oil prices, a year ago, a barrel of oil was running about $85 a barrel. Now it's running about $60, and it's been bouncing into the 50s. And that's has brought fuel prices down. I don't know about you, but I went to the fuel pump, and for the first time here in Arizona, I bought fuel for under $3 since 2021. So it was kind of a good feeling. But I don't think everybody's realizing and feeling it yet, but it is coming. These, you just can't have lower taxes. You can't have, lower inflation without at some point it's starting to be realized. And I think that the jet, our 747, is making its final parts of its turn. But even when we get to May and we get a new Fed, there could be a pause without moving the Fed rate, just so the new Fed can reevaluate the economy. Now, my understanding is the two front runners to take over the Fed are Kevin Hassick and Kevin Warsick, who both already have a finger on the pulse of the economy. So I think if they are appointed as the Fed and confirmed by the Senate, I think you're going to see some things move quick. But there is always the possibility that they may pause things. Many investors are, kind of waiting for rates to drop back into the low fours. And so they're sitting on the sidelines. Many of us investors who, this is our business, we haven't been able to. So we've really had to, target and scale and evaluate and find opportunities, niches in the market we're in. And that is unlikely to change much in 2026 unless we see, a real big pullback, I think. In other words, I think the era of cheap money may be behind us until somebody messes up the economy again. And this means that investors who are waiting on the perfect rate could be waiting for years and potentially missing opportunities. Okay, here's number 5. What lower rates mean for real estate investors. So let's talk a little bit about strategy. If rates do gradually decline 2026, here's what it likely means. It'll mean increased competition. As rates fall, more buyers re-enter the marketplace. That's great for us investors who are selling, who are working in the flip market, but it'll also bring more investors back in, and it'll also strengthen real estate markets, so it'll bring more buy and hold investors back in. So it'll benefit both flip investors and buy and hold investors. It'll put some, number 2, it's going to put some pressure on prices, probably upward. Lower rates will bring more, competitive investor opportunities. So we may have to be competing against, investors like we did back in, 2018, 19, 20, 21. A lot of the deals that we've worked on lately, we don't have any competition. We're the player in town that are looking at their opportunity. There's going to be some refinance opportunities. For investors who are holding properties with higher mortgages, private money, and investor loans, this may be good. There may be an opportunity now to buy long-term properties, at today's rates while there's not a lot of competition, and then refinance them to lower rates when they come down towards the end of the year, improving your cash flows without having to win bidding wars later. So there's some benefits here. Our key takeaway is just because rates don't drop automatically, or just because rates drop, it's not going to automatically mean better deals. Often the deals exist when others won't, compete until rate falls. So that's what we've been finding now. We have less competition now than we certainly did, 4 years ago. And so sometimes it's better to buy now and with seeing declining markets, be ready for the drop. Okay, 6th, smart plays investors are making in 2026. The investors who tend to win in shifting markets, they do so by doing a few key things now. They're buying deals that make sense at today's rates. You know your winning numbers, and be a little conservative. Plan for an extended hold. Maybe you're purchasing something that you want to flip, but you keep it as a hold property. Maybe you buy something now and you do the work on it, repair it because you want to hold this thing. And when the rates shift, then you refinance it and develop better cash flow with it. Maybe use more creative financing, subject twos, lease options, whatever. Be creative in acquiring properties. And then get prepared now to do your refinances. So when interest rates drop, don't be the one scrambling. Be ready so that you can get in, get the things done, and take advantage of the opportunities as quickly as you can. But let me conclude with this. It's very likely that mortgage interest rates will come down in 2026. Don't bet on a huge rate drop. For real estate investors, the goal isn't to time the rates. It's to prepare for them. Make smart, sustainable decisions. And just get ready. I think 2026 is going to be a very good year for investors and the economy overall. If you found this episode today valuable, be sure to subscribe, leave us a review, share it with another investor who could use to hear it. That's all for this episode. I want to thank you for joining me on the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes of related real estate investing topics. I'm glad you're part of our growing real estate community, and you can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on the next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.